A few weeks ago, I processed a $2,000 payout from FTMO, and I want to do something different today. I'm not going to teach you my full strategy, but I will show you the trade that played a huge role in that payout. And most importantly, I will show you the part that most people ignore, the decision-making process behind the trade, the emotions I had while managing it, and the lessons I took from it, including the part that actually bothered me once it was all over. Alright, let me take you to December 16, 2025, and to a market that I don't usually trade, silver. So, the market context was clear. The higher timeframes were bullish, and on the daily timeframe, price retraced into a fair value gap, an imbalance area that, in my framework, can act as a zone where the market tends to react. Now, here's the first important part of the story. Price gave a beautiful reaction from the daily fair value gap, and I did not take it. Not because the opportunity wasn't there, not because I didn't see it. I hesitated because I'm not used to trading silver. In that moment, my brain wasn't thinking, is this valid? My brain was thinking, what if I'm wrong because it's silver? And that hesitation matters because it creates a specific psychological chain reaction. You miss the clean entry, you watch price move without you, and then you start thinking about jumping in late, emotionally. That's where people usually get chopped up. So at that point I had a choice. Either I accept that I missed it and wait for the next clean opportunity, or I try to force a trade because I want to make up for what I missed. And that leads to the next part of the story, because a few days later, price came back. After a few days, on the 4-hour time frame, price retraced quickly back into a new fair value gap. But the reason I entered isn't because I saw the fair value gap again. The reason I entered was because the daily candles looked like a retracement, not like a reversal. And again, I'm not going deep into the strategy here. I'm talking about reading intent. To me, that pullback didn't look like the market was trying to collapse. It looked like the market was simply taking a breath inside a strong bullish environment. Now, this is where people usually misunderstand the word intuition. When I say I use intuition, I don't mean I gambled, I don't mean I guessed, I mean something very specific. Intuition is compressed experience. It is the result of hundreds, sometimes thousands of repetitions where your brain learns patterns and probabilities, and it gives you a signal before your conscious mind can fully explain it. That's why intuition feels like a feeling, but it's actually information. Now, here's the important part. Intuition works only if it's filtered by rules. If you rely on intuition with no structure, that's not intuition, that's impulse. So, I used intuition, but I still needed a trigger that made sense to me. And for this trade, my trigger was simple. I decided to enter as soon as the 4-hour candle closed above the previous candle's high. Is that how I normally trade? No. Normally, I want to enter right after price engages a higher timeframe fair value gap like the earlier scenario I showed, the cleaner one that I missed. But I deviated from my typical execution because the trend was strong, the pullback looked corrective, and I had a clear invalidation area. And also, my intuition was aligned with the bigger context. And let me be clear, deviating from your standard plan is dangerous. Most traders use intuition as an excuse to break rules. So here's the real lesson. You can deviate from the blueprint only if you have earned the right to do it, and only if you can define risk clearly. Once I got in, price went in my favor almost immediately. It created a new 4-hour fair value gap, it broke structure, and at that point, I made a decision that I think was the key to managing this trade correctly. I traded my stop loss to break even, but not break even because I want to be safe. I moved it to a level that made sense structurally, around the end of the fair value gap. This matters a lot, because if you move to break even randomly, what happens? You feel safe, then price retraces a little, you get stopped out at break even, and then the market continues without you. That creates frustration and revenge trading. But if your stop is at break even and at a logical point, then you're not just protected, you're aligned with the story your trade is telling. My logic was, if the market truly wants to continue higher, I don't want to see price come back and completely fill that imbalance. I want to see it act as a support. So, during the retracement, I wasn't calm because I'm at break-even, I was calm because my stop was placed at a point where the market would have to invalidate my idea to hit it. And you can actually see it. Price did exactly what I expected. It reacted, it respected the area, and it continued higher. Now, this is a big psychological lesson. Confidence doesn't come from positive thinking. Confidence comes from logic plus preparation. When your stop makes sense, you can tolerate volatility without panicking. From there, it was basically price discovery. And this is where things get interesting, because managing a trade in price discovery is not as easy as people think. When price is at all-time highs, you don't have obvious levels above you. There's no clean resistance to lean on. There's no target that feels guaranteed. So you have two choices. Either you try to predict the top, which is usually ego, or you accept you can predict the top and you manage based on structure and risk. I chose the second. I kept trailing my stop loss at logical points as price pushed higher. And now comes the part of the story that people don't usually admit. This trade gave me 4 Rs, but at the highest point, it reached around 8.6 R. So yes, I left money on the table. Here's what I did. I took half off at 4R, and then I got stopped on the remaining position with my stop trailing at 4R. And in the moment, that bothered me, because when you see price reach 8R and you only made 4, your brain starts doing something toxic. It starts to rewrite the past. It says, you should have held, you were stupid, you missed out, you don't know how to maximize profits. And that mindset destroys traders. So I had to remind myself of something that separates consistent traders from emotional traders. Your job is not to capture the entire move. Your job is to execute a repeatable plan. If you try to squeeze every last pip out of every move, you will eventually give it all back when the market snaps. And let's be honest, there is absolutely no way I was going to keep my stop at break-even after the trade was up more than 8 hours. That's not discipline, that's gambling. So the deeper lesson here is about trade-offs. If you want maximum profit, you accept maximum drawdown. If you want consistency, you accept leaving some money on the table. Consistency is the price you pay for emotional stability. Now, let me extract 3 principles you can apply even if you trade a totally different strategy. Number 1. Don't confuse intuition with impulse. Intuition is earned. It's experience compressed into a signal. Impulse is emotion dressed up as confidence. If you can explain your invalidation, if you can define your risk, and if you're entering because you're afraid to miss out, that's not intuition. A simple filter you can use is this. If I take this trade and it loses, will I still respect myself because the decision made sense? If the answer is no, don't take it. Number 2. Break-even is not a level. Logic is. Moving to break-even doesn't automatically make you a better trader. Break-even is useful only if it aligns with the narrative of your setup. Instead of thinking, I need to be safe, think, where does my idea become wrong? That shift alone will improve your psychological stability because you stop getting randomly tagged out. Number 3. Your exit will never be perfect, and that's okay. If you measure your skill by how close you exit to the top, you will always feel like a failure. You're not a prophet, you're a risk manager. So decide in advance what you want to optimize. Do you want smoother equity, or do you want occasional massive winners with big swings? Both are valid, but mixing them emotionally, trade by trade, is how you self-sabotage. So yes, this trade helped me secure the payout, but the real win wasn't the money. The real win was that I executed a decision I could justify. I managed the risk logically, and I handled the emotional part, even the frustration of leaving profits on the table, without turning it into overtrading. And that's what people don't see when they look at payouts. A payout is not a single trade. It's proof that, over a series of trades, you didn't self-destruct. If you want to become consistent, focus on building a process that you can repeat, even when you feel hesitation, even when you feel fear, even when you feel regret after a good trade. Because the market will always give you reason to doubt. Your edge is how you respond. If you like this video, please leave a like and subscribe, and I'll see you in the next one.